All right, federal regulators testifying on the banking crisis in a Senate hearing today. Regional bank stocks trading mixed in reaction. For more on how banking turmoil is impacting the markets, we turn to Kathy Jones, Charles Schwab fixed income strategist. Nice to see you, Kathy. What from where you sit is the impact on the markets?
Well, I think it's a lot of political grandstanding today, as you normally get in these types of hearings. And I'm not sure that they uncovered anything that we didn't already know. I think the upshot, though, is that there's likely to be more regulatory scrutiny around the small, medium-sized banks. These are the banks that provide funding for commercial real estate and for the commercial and industrial loans to a large extent. So if you add regulation on top of the fact that they're probably already looking at their assets and liabilities and their positioning to make sure that they're in better shape, there'll be tightening credit conditions, and that will probably slow the economy. So all this may be have been going in slow motion, but now it will probably speed up as a result of these problems.
How soon then, Kathy, could we potentially see a recession?
Well, I wouldn't rule it out for the end of the year, although it's really always tough to time these things. But certainly the end of this year into 2024, barring some sort of major surprise in looser financial conditions, which doesn't seem likely, I would say it's a 6 to 12 month time frame that it's a pretty high risk of recession.
The tightening lending conditions that result from the collapse, does that equate to some measure of tightening from the Fed? And do you expect further Fed tightening at the May meeting?
Yeah, it certainly does. It's hard to model out exactly how many basis points this is worth. We really won't know until we get further into it. The Fed is currently still projecting another 25 basis point rate hike at the May meeting. That's their intention right now. I'd be surprised if there was a major reason to do that. But I have been surprised that in the midst of all this turmoil, the Fed kept hiking rates anyway. So I suppose if they really desperately want to get another 25 basis points on the books, they'll go ahead and do it. But I think it just adds to the risk to the economy.
And Kathy, Wall Street is very, very split just in terms of the Fed's next move, whether or not it should hike, and also potentially the timing about whether or not and when it should cut. We heard from Evercore ISI's Krishna Guha earlier today, and I want to play a quick thought here from him and then get your reaction.
Bar for pausing is not that high, but the bar for cutting is much higher. And it's not just higher in a quantitative sense, it's higher in a qualitative sense as well. Meaning that you can pause on a sort of expectation that things are going to move in a more disinflationary direction. But in principle, at least, you're only cutting upon substantial further realized progress in moving towards inflation heading back towards target.
That was Krishna Guha of Evercore. Kathy, what do you make of his comments and what that could potentially mean for the Fed by the end of the year?
Yeah, I think he hit it on the head. There's this conflict between the perception of what the Fed will do and what the signal it wants to send. It doesn't want to send the signal that it's going to lower rates unless inflation is really actually declining pretty significantly, not just the expectation. So I do think he's hit it on the head in terms of this is a signal that the Fed wants to send. The reality is, though, that we have the potential for a significant slowdown in the economy, rising unemployment, falling inflation. If we're headed in that direction and there's stress in the financial system, it's going to be hard for the Fed to just sit on its hands. That doesn't seem to make a lot of sense.
All right, we agree there. Kathy Jones, nice to see you. Thanks so much.